Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi ta'ala wabarakatuh. So we shall continue with the next topics in IMU303. The topic is risk management in Takaful operations. Right. So before this, we look into Islamic banks and Islamic finance. Now we look into Takaful. Okay, so for today, the content is about type of risk in Takaful operation. We will look into underwriting risk, operational risk, credit risk, liquidity risk, and market risk, and ways on how to manage this risk, right? So for today, the expected outcome is that for you to be able to explain the general information about Takaful. This is just very brief, just general information. And then to justify the type of risk in Takaful operations, what is the main risk and stuff, and then discuss ways on how these risks are being managed in Takaful operations. Okay, so as introduction, what is Takaful, right? So Takaful is derived from Arabic words which mean joint guarantee, right? Whereby a group of participants agree to jointly guarantee among themselves against a defined loss. Okay, that is from language perspective, language definitions, right? But then Takaful is also an arrangement based on mutual assistance under which Takaful participants agree to contribute, right? So this is the main difference between Takaful and insurance, whereby in insurance you pay for the premium, right? But then in Takaful you contribute, right? So you have your contribution to a common fund, providing for mutual financial benefits payable to the Takaful participants or their beneficiaries on the occurrence of pre-agreed events, right? So that's the main difference between insurance and Takaful. Insurance, you pay for the premium, right? And as a result of you pay for the premium, if anything happens, the insurance provider will reimburse you, right? But in Takaful, it is actually a contribution, right? So that's the main difference. Okay, so we have quite a number of Takaful operators in Malaysia, right? And then we have locally owned and foreign owned Takaful operators. We have a company who also have insurance, right? For example, AIA, MetLife, Etika also have insurance. Great Eastern also have insurance. Prudential also have insurance, right? But they have the Takaful, right? And for the Takaful, they also separate, right? There are separation between family Takaful and also general Takaful, right? You see is syarikat Takaful. You have a syarikat Takaful Am and syarikat Takaful Keluarga, right? Takaful Ikhlas family, and Takaful Ikhlas general, right? Same with Zurich general and for family actually. Okay. And then at the same time, we also have a Retargetful Operators, right? So Retargetful Operators, this is names that you might not be aware of, right? And they are not familiar to you, right? And they are not well known, so to speak, right? What is Retargetful? Is an I will read the definition first. Is an arrangement or mechanism. It's either by an agreement covering a class of Takaful product on risk by risk basis that enables a direct Takaful operator to transfer or cede all or part of the risk that is accepted to another Takaful or Retargetful operator, right? In simple words, they are the Takaful for the Takaful companies, right? So let's say for the Takaful companies, right, they accept this kind of risk, right? For example, they covered for 100 planes, for example, planes, aircraft, all right? Okay, so they covered for 100 planes, right? But the risk for 100 planes is quite big, right? Assuming, let's say, one plane go down, for example, right, or go missing, for example, the amount that you need to reimburse to your client, right? So maybe in this case, AirAsia or Malaysia Airlines, right, is very big, right? One plane is about what, 100 million, 200 million, I'm not sure, right? So even one would have a significant impact uh, on your revenue or your money, right? So what happened was that these Takaful companies, they transfer, they apply or they buy a Takaful with a Retargetful companies, right? So that these Retargetful companies would cover some of the risk, right? For example, Etika, for example, Etika Takaful, they covered, they have a agreement with AirAsia for 100 planes, right? Takaful covered for 100 planes, right? And then this is the risk, this is quite big for Etika, right? So what Etika did was that Etika transfer some of the risk to a Retargetful company, right? For example, ACR or maybe Malaysia Re or Malaysia Re or Swiss Re, right? Let's say they transfer to Swiss Re, right? So 100 plane that they get from Malaysia Airlines, maybe they will get about the premium that Malaysia Airlines pay, Asia pay, maybe is about 1 million, for example. Just an example, 1 million, right? So what happened was that they are willing, they are okay to take 10% of the risk, right? So they would transfer the balance of 90% to Swiss Re, right? So by transferring the balance of 90% of the risk towards Swiss Re, they would have to pay some premium to Swiss Re, right? So how Swiss Re is able to stomach this amount of risk? Because Retargetful, they are operating Retargetful or reinsurance, reinsurance company or Retargetful companies, they are operating globally, right? When they are operating globally, because we are talking about re company is not much, not that many, right? And they accept, they can buy this particular risk from all over countries, right? For example, maybe before this, Etika give them 100 planes, right? So 100 planes, and then they have maybe an agreement with insurance Takaful company in Germany, for example, covering Lufthansa, right? So Lufthansa have 200 planes, right? With let's say what company name? Munchen Takaful, for example, right? And then Munchen Takaful sell the 200 to Swiss Re, right? And then in Thailand as well, in Indonesia as well, right? So in the portfolio of Swiss Re, there are maybe 2,000 or 3,000 airplanes, right? That they covered, right? So the risk of one or two or three gone miss, flight airplane goes missing, or being shot down, or crash or whatever, right? It's not that much towards them, right? Because they have a lot more, right? So it's and then even then the probability of that's happening is very low for them, right? 1 in 3,000, right? Compared to the Swiss Re before, compared to the Etika before, 1 in 100, for example, right? So the risk for Etika is much higher, right? But Swiss Re, because they have a huge portfolio, and not only planes, they have buildings and whatnot in all over the globe. So the risk is much lower for them, right? Even if that occurrence happen, if that particular accident happen, they would able to pay. They have the money to pay, right? If they don't have, they just go bust, right? Simple, right? It's not, of course, it's not that simple, but it is what it is lah, right? Okay, so that's just an idea of what is Retargetful. Of course, in the detail is much more lah, right? Okay, so next we're going to look into type of risk in Takaful operations. So we have underwriting risk, we have operational risk, we have credit risk, liquidity risk, and market risk, right? So the other four risks you might be okay with that. You have heard of it before: operational risk, credit risk, liquidity risk, market risk. So you have listened to it before, right? But the new one, the underwriting risk, might be something new to you, right? And actually, underwriting risk is one of the main risks in Takaful and insurance, so to speak, right? So underwriting risk. So underwriting risk is the risk of loss borne by an underwriter, right? Okay. So in Takaful, underwriting risk may arise from an inaccurate assessment of the risk associated with writing an insurance policy, or from uncontrollable factors. So as a result, the insurer's cost may significantly exceed earned premium, right? Okay, so the risk of adverse selection arises when applicants with higher than average chance of loss succeed in obtaining Takaful coverage at standard rates. Okay, so this is just a simpler definition of what is underwriting and stuff, right? I'm just trying to explain to you in simpler words. Okay, so underwriting, what basically underwriting is that, okay, for example, you want a person wants to get a Takaful coverage, right? Okay, so based on the profile of that person and their history, medical history and whatnot, the family history. So based on that calculation, you charge the people the premium that they would have to pay is 100 ringgit per month, right? Okay, so if your underwriting is true, right? If what you measure, what you calculate is true, what you assess is true, the person would not claim much more than what they paid, right? Okay, in other words, of course we talk about not only one person but not a pool of people, right? So but then if your underwriting is bad, so to speak, bad, right? You are not good in underwriting. Your underwriting department is not good, right? Means that you underestimate your risk, right? For example, this is what happened before. People are getting up a Takaful from a particular companies, right? Why? Because that particular companies, Takaful operators, offer a cash amount if people got warded, right? So a lot of people go for it, right? And then when people go for it, initially the amount charged is much low. Contribution amount is just quite low, right? Let's say 150 ringgit per month, right? And suddenly there's an influx of people going into hospital, getting warded, right? And then of course when you get warded, there are inspectors who will check the claims and stuff, and it's not that easy, right, to get to being warded, right? And hospital need to be answerable to the insurance operators and stuff. But then during that particular time, I'm not sure what happened, but a lot of people got warded and they received their cash amount, right? So if you, let's say you got warded 5 days, you get 100 ringgit per day, you get 500 ringgit, right? If you get a week, you get 700 ringgit, right? So that's one person, but then we're talking about thousands of people, all right? Whereby, let's say your monthly contribution that the Takaful companies get is about, let's say, 10 million, right? But then the amount that they have to pay on that particular month is 15 million, right? So you exceed, right? So that means when you exceed, you need to increase the people contributions, right? So people need to pay more, right, as a result, right? So, but if your underwriting department is good, your underwriting policy is good, whatever people pay should be enough, right? Of course, you should not deny the people's right? There are, of course, instances where insurance or Takaful operator, this is just an example, insurance or Takaful operators denying the customer's right of getting treatment, right? This is one of the ways to reduce, one of the ways that being used, right? Of course, you can report it to the bank negara and stuff lah. That's a different context, right? So the context of insurance and takaful here is a bit different, right? So insurance companies, they want to protect their shareholders' interests, right? So because you pay for the premium and you are expecting to get that amount of protection or what based on the agreement, right? And it doesn't matter whatever happened to the holders, right? Let's say the amount that collectively people paid is 15 million, right? But then the insurance need to pay, reimburse to the hospitals and stuff 20 million, so it doesn't matter to them, right? They have to pay using their shareholders fund, right? The difference with takaful is that it is from a pool of fund, right? So you contribute, we contribute to a pool of fund, right? So let's say monthly we contribute 15 million to that particular pool of fund, right? But if the money that need to be reimbursed to the participants is more than that, let's say 20 million, so we need to top up, right? So we need to top up more. Of course, shareholders also need to top up more, right? To get to cover lah for the shortfall, right? So that's why the underwriting need to be very good in that context, right? So that's why when you want to apply for takaful or insurance for the say, they would ask a number of questions, right? What is your medical history? Do you have diabetes? Do you have a heart attack? Do you have high blood pressure, right? So basically, if you have this kind of disease, they would straight away reject you, right? If you smoke, you would have to pay a premium for smoke, right? So if you have a family with medical history, again you have to pay a premium for that, right? So let's say if you are older, you have to pay more, right? So it depends on the risk that is being assigned to you by the underwriting department of the insurance or takaful companies, right? Okay, this is quite detailed, so hopefully you can try to grab some of it, right? Okay. Next one is operational risk. So this one is something that you have discussed before. Is a loss that occurs as a result of insufficient or failed internal process, people, technology, or from external events, right? It can be from insufficient or failed internal process, for example, inaccurate processing of transaction, inefficient record keeping, and then you can have a people risk, so incompetence of employees, right? So in this context, again, when you are operator, you are insurance or takaful operators, the agents, although they are not your direct employees, they are considered as your employees, right? So if the agents make a mistake by whatever, right? So the takaful or insurance company need to own that particular mistake, right? So that's an extra risk if you use a agency model, right? Like what being used by a lot of takaful and insurance companies in Malaysia, right? Of course, there are insurance and takaful, I'm not sure, who are not using agency model, right? They can just use direct. You can subscribe from the web and settle, right? Okay. Next is technology risk. So you can have a telecommunication system or computer network breakdown. This is normal. And then you can have external event, right? So you can have an unenforceability of regulatory policies, legislation and regulation that affect the fulfillment of contract and transaction, right? And then of course the policy that's being governed will have a impact on Takaful and insurance, right? Because they are being governed by negara Malaysia, right? And in the context of Takaful, again, they need to be aware of SAC, Sharia Advisory Council regulation by negara Malaysia as well, right? So there are also Sharia risk there. Next is credit risk. So result of default of counterparty when it fails to meet its obligation on time and in accordance with agreed terms. So it may be treated as default risk, migration risk, separate spread risk, or concentration risk. Okay, so default risk, for example, Takaful operator does not receive or partially receive cash flows or assets to which it is entitled because the other party fails to meet the obligation of the contract. So this is quite normal actually, right? People pay late for their contribution of premium, right? So if pay late, 1 month still okay, 2 months still okay, but if more than certain number of months, you are considered default, right? So you are no longer protected in that sense, right? And it's not good either for the Takaful companies, because Takaful operators, because they no longer receive the cash flows, right? No longer receive the revenue, right? And then you can also have a migration risk. So probability of future default of an obligator adversely affect the contract today, right? And people might migrate to another companies even, right? For example, this company, this stock for operators, always every 6 months increase premium, every 6 months increase contribution, every 6 months increase contribution. People are being fed up, right? So people migrate to another Takaful companies, right? And then you can also have a spread risk, so market perception of increased risk on either micro or micro basis, depends. And then you can have a concentration risk, so increased exposure to losses due to concentration of investment in particular geographical area or economy or industrial sector, right? So this is related to the investment by the Takaful companies. Of course, Takaful companies do make investment, right, to because they have money, right? So they need to invest to get at least top up in that context for the participants, right? Next is liquidity risk. So liquidity risk is the risk resulting from Takaful companies' inability to meet obligation when they fall due, right? So includes liquidation risk, affiliation investment risk, and capital funding risk. So liquidation risk is risk under circumstances when assets are liquidated below their real market value, right? So when you are in dire need of cash, you would just have to sell whatever at whatever amount, right? So it's a loss lah in that context, right? Affiliation investment risk is the risk that investment in affiliated or member company might result in drain of financial or operating resources, right? So you over invested, or maybe you spend too much time on that particular investment, or you spend too much human resources on that particular investment, right? And then you can also have a capital funding risk. It's the risk that insurance company will not be able to outsource fund in case of large claims, right? So this is if large claims occur, the big accident occur, right? And then market risk. Market risk is the volatility of prices in instruments and assets of Takaful company in the market. It can be classified as equity price risk, interest rate risk, and currency risk. Okay, so equity price risk is the risk of loss resulting from changes in market price of equities or other assets, right? In simpler words, Takaful companies do invest in stock market. They buy certain shares, right? So when this price of shares go down, they lost, right? Of course, paper loss, but still a loss, right? And then interest rate risk is the risk of loss resulting from changes in interest rate that adversely affect the cash flows of the insurance company, right? Okay, in simple words, when interest rates go down, Takaful companies have investment in money market, right? So of course, Islamic money market in that context, right? So when interest rate go down, it would affect the rate of the profit rate of Islamic money market as well, right? So in which case the profit will go down as well, right? And then you can have a currency risk, so loss resulting from volatility of exchange rate that adversely affect the operation of insurance company. Of course, this is if you are involved with foreign foreign countries, right? So how to manage this risk? Okay, so first of all, we look into underwriting risk. So to manage underwriting risk, first we establish standard selection procedure that is consistent with the company's objective, right? So most of the Takaful operators require physical inspection or medical reports of the applicants that have serious health problem or prone to a higher than average risk, right? So if you are considered as higher than average risk, usually Takaful operators would require you to have medical checkup, right? So if your medical checkup says okay, right? But if your medical checkup have some problems and stuff, so the Takaful company would either straight away say no to you, right? Or they would accept you with caveat, right? So depends lah, whatever caveat that they put, right? Or maybe they would exclude you from getting treatment for certain type of cases, right? Depends, right? So nowadays, the Takaful companies also introduce computerized underwriting system to standardize underwriting procedure and minimize the chance of adverse selection, right? So, for example, Takaful class, they use computerized underwriting procedure for Takaful. Next, to manage operational risk management. So, senior management and board of directors of Takaful companies should devise policies and develop strategies to manage and reduce operational risk. So you recruit talented professionals in the field of IT so that they could develop software to meet particular needs of Takaful industry. And in this context, auditors play an important role in justifying operational risk as they point out flaws in internal process of the organization. Okay, next on credit risk, how to manage credit risk. So you limit on maturity of credit facility, right? So you would invest or being involved with a short-term credit over long-term credit, right? So, and you also limit on maximum investment amount or certain percentage of investment exposure to a single issuer, industry, geographical region, or some other risk classification, right? The non-availability of Islamic derivative ensures that credit risk exposure are maintained within limits of prudential standards defined by internal controls. But then, of course, there are some Islamic derivative that is being used for credit management purposes, right? But that would be quite detailed to be discussed. So we can talk about it in the class later. Okay. To manage liquidity risk, you can have two models, so to speak, right? First is cash flow modeling. So you assess the amount of deficit, surpluses, or liquidation value risk in order to meet the needs of Takaful industry, right? So you make sure that it has sufficient liquid assets in order to meet liquidity risk and unexpected liquidity requirement, right? So basically, you prepare, you have a number of assets that is liquid, right? But of course, too much is not good either, right? Because usually liquid asset does not give much return, right? It just certain low return, so to speak, right? So you don't want to over invested in liquid asset, right? At the same time, you don't want to be under invested in liquid asset, because if something happen, you need liquid asset to be sell, right? And then the other tools is liquidity ratios. So liquidity ratios will help Takaful operator to set the amount of liquid assets required to meet demands of liability portfolio, right? So it is used to determine Takaful operators' investment policies. Okay, next we look into how to manage market risk, right? So in conventional insurance, management of market risk include devising strategies to manage interest rate risk, exchange rate, and commodity price risk, right? They can use derivatives to manage this particular risk, right? But then for Takaful operators, they face difficulty in managing this risk, right? As the instrument, the financial derivative instrument, most of it are not compatible with Sharia, right? So you have a LIBOR, right? Of course, this is based from LIBOR, right? LIBOR is London Interbank Offered Rate. So you have a LIBOR, Kuala Lumpur Interbank Offered Rate, that can be used as benchmark for markup in Islamic financial institution, right? And then you have some form of hedging being used, right? For example, cooperative hedging and bilateral mutual adjustment that are acceptable under Sharia to mitigate currency risk and also other type of risk. But then there are currently some kind of derivatives that are compliant with Sharia, right? Again, it is debatable whether that is completely compliant or not, but then some scholars allow it, some are not, so I will not go into the detail of that, right? So conclusion, so risk management is very important for Takaful to provide a way in managing risk in Takaful according to Sharia principles, right? So there are 5 types of risks that have been identified in this lecture that affect operational and investment function of Takaful operator. So risks associated Takaful have raised several challenges and need to be encountered to enhance risk management practices, right? So regular Sharia audit is found to be an integral part of effective internal control that prevents the company from another crisis. Exploring those solutions will help to meet the challenge of financial engineering, and Islamic financial market will greatly facilitate the task of Takaful companies to invest large portion of their fund in Islamic financial instrument and increase their efficiency and competitiveness. Right. This statement, to be clear, because Takaful company do invest their fund, right? And then for Takaful companies, specifically, they need to invest their fund in Islamic financial instruments, right? They need to invest in Sharia compliance product, right? So there is a need for a good Islamic financial market, right? And Takaful is one of the main funder, so to speak, for the Islamic financial market, right? So this is the references that you might want to look into. So that's all for this week. We shall continue in the next week for the next chapter, inshallah. Thank you. Assalamualaikum warahmatullahi wabarakatuh.